you, and thanks so much for having me out to the conference. It's been a lot of fun. This paper is joint with Abby Sussman, who's in our marketing group. And so it's a paper about sustainability, which is a bit weird for kind of a finance crowd. But I think if you've opened the Wall Street Journal or the Financial Times recently, you've come across many examples of firms doing costly things in the name of some sort of sustainable environmental type goal. And so that leads to the question of, well, should these firms be doing that? And I think the answer is it depends on the preferences of their investors, and that's where things get a bit hazy. Because if you just think across your friends or colleagues or just various smart people, you'll find very different opinions. So you'll find some people who think this is just purely bad. That you should not be focusing on things like sustainable endeavors. Firms are there to be making profits, so I'm here from Chicago. Clearly one of the biggest proponents of this was Milton Friedman, who wrote, "There is one and only one social responsibility of business, to use its resources and engage in activities designed to increase its profits." So that's definitely one opinion that's out there. But if you kept going through your friends or various acquaintances, you'd come up with other people who said, no, this is a good thing, and it's a good thing because it's good for profits. Investing in sustainability in the current regulatory environment or political regime is something that firms should be doing. And so here's Bob Shiller saying there's a long-run advantage in ethical business. They have a good chance of outperforming. So sustainability could be just pure agency bad, it could be good profit maximizing, and of course it could be good because it's the right thing to do, because maybe firms should be reflecting more than just profits. And so kind of this non-pecuniary thing, I didn't have another Nobel Prize winner, but actually the Pope has gotten very big into impact investing. And so at a conference on socially responsible investing, he wrote, investments of this sort are meant to have positive social repercussions. The financial return for investors tends to be more moderate than in other types of investments. So you should be investing in social responsibility, but you realize that it comes at the expense of future return. So all these guys are smart guys, they're all out there, so what about collectively? What does kind of the market on average think about this type of stuff? And of course, that's a really hard question. So it's very hard to identify who kind of this average investor would be. We probably wouldn't believe them if we could find that guy. There's, I'd say, a definite chance for kind of a silent majority here of people who probably want financial folks to focus on the dollars and cents and just don't speak up especially loudly. In the markets, everything's already in equilibrium. People have sorted into different firms. There is variation in things like how sustainable a firm is, but if you're a coal firm and you become a solar firm, your sustainability has shifted dramatically, but every aspect of your business has as well too. And also, if we're thinking about kind of firms, we typically look at something like stock prices, where you just always have the joint hypothesis problem, and it's not the most clean measure of demand. So in an ideal world, what we'd want is there to be a whole bunch of different investments, and that basically the sustainability of those investments was randomized, was done so in such a way that it didn't directly impact fundamentals, and you had some measure of how investors felt about that in aggregate, kind of how demand shifted around. So clearly that's going to be difficult in many financial settings, but I think we're going to come fairly close in this paper. So what we're doing is we're examining a shock to the salience of sustainability, which is that Morningstar published sustainability ratings for basically the entire universe of US open-ended mutual funds. Before this, it was pretty hard to kind of get any information from most funds about how sustainable their investments were. This was a big shock. It basically hits the entire US mutual fund universe. And the ratings were all based on publicly available information. So there's not anything new that was baked into these things. No fundamentals were directly shifted. It was just repackaged in a really easy 1 to 5 globe scale. Mutual funds are great in this case because we can observe flows. Did the funds grow or shrink is a measure of demand. And then we're going to run an experiment at the end to try to kind of figure out what's going on in our results. So This is the main kind of finding in our paper. So the dotted line is the publication of these sustainability ratings. The blue line are funds that were rated high in terms of sustainability. The red line low, and these are the cumulative funds to the right for the 11 months after the sustainability rating publication. So to the left of the line, you can see that in general, these funds basically were insignificantly different. And then afterwards, the blue line goes up a lot. That's telling you that over the next roughly year, the high sustainability funds gained 4 or 5% of total size. The low sustainability funds lost about 5% of total size. So this seems to have mattered. It seemed to have been pretty large and significant. And it seems that investors, on aggregate, put a positive value in terms of where they allocated their money to funds that were rated high in sustainability, not low in sustainability. So the first bit of the paper, which is what I think we can identify quite cleanly, is that these ratings basically induced a pretty large response. We're estimating over $20 billion flowed out or into the high sustainability funds, about 15 out of the low sustainability funds. Basically, investors are going to respond to this very simple rating system from 1 to 5, and they're going to ignore a lot of other information that Morningstar put out there. Now, the nice thing in terms of identification is then we can look at a bunch of stuff to show that around breakpoints and stuff like that, it really is the ratings that are driving stuff. So investors are responding to these discrete ratings, and then we want to make a little bit of progress into the question why. So what's going on? And so this is going to be not nearly as clean or as definitive. And what we're going to show you is that institutional investors, at least as proxied by institutional share classes, behaved similarly. So they seem to kind of have similar flow responses, which means it's not driven by institutional investors alone, which is one theory you hear a lot. Or we're going to run an experiment that suggests that investors thought high sustainability funds were just better. They were going to have higher returns and lower risk. We aren't going to find that in the data. We're going to find weak evidence of underperformance or no relation, depending on how you kind of want to look at it, but definitely not evidence of strongly more positive returns. In our experiment, we're going to also find some evidence consistent with non-pecuniary motives as well. So that's where we're going. Let's briefly talk about what these ratings were. So this is how Morningstar kind of talked about it. These were ESG ratings, which is a buzzword in this part for environmental, social, and governance. And what did they do? Well, they said it helps investors put their money where their values are. So that's the type of thing that Morningstar tended to talk about with these ratings. Now, how did they do that? So what they did is they took ESG ratings for firms from a company called Sustainalytics. So Sustainalytics has these numeric ESG ratings. They took the portfolio holdings that they clearly had and did a weighted average of that ESG score. Then they took that within each Morningstar category, looked at your percentiles within Morningstar category, and the top 10% of funds in that category were high sustainability, the bottom 10% were low sustainability, with 2, 3, and 4 being kind of shades of average in the middle. Now what's important here is that the Sustainalytics stuff, this is a firm who makes money publishing these ratings, so these were publicly available and known. Holding weights, those were already on Morningstar, again publicly available and known, and clearly the Morningstar category is known as well too. So this is just repackaging stuff that could have been done. I think we won't be surprised to know investors weren't doing this, but it's not like there's new fundamental information underlying these funds in terms of what's going on. So now if you go to Morningstar's website, you'll see a box like this on a fund's webpage. So this is for Fidelity Magellan Fund. So it's in the large growth category, and in that category it's 2 globes out of 5, so below average. You can see below it is kind of more detailed information. So it's the 86th percentile in large growth, and it's got a raw score based on its kind of averaged holdings of 43. So that's kind of the number you would care about if you kind of cared overall about the sustainability, not within category. So that's how they constructed the ratings. So now we want to know, okay, what happened in terms of flows? So the first thing we're going to do is we're just going to put flows on the left-hand side, regress it on kind of the various sustainability measures and a bunch of controls. So Morningstar gave us all the data underlying this. So that's what we're using here for about a year after the publication of the ratings. So if you put in the sustainability score or that category percentile rank, those two small numbers in the box, there's not much action going on there. But if you put in dummy variables for each of these globe ratings, you see that there's strong response to the extreme rating categories. So one globe funds over the next 11 months lost about 0.44% per month. So this is they lost about 6% per year. The 5 globe high sustainability funds, they gained about 0.3% per month, again about 4% per year. So we see a strong response to the market. You might be, and we don't find any action going on the kind of the middle ranked 2 and 4. It really just seems like investors care about this kind of extreme 1 and 5 globe category. You could be worried that we're capturing a bunch of different stuff. This has controls for size, various lagged returns, the Morningstar star rating, fund to age, expense ratio. Things are generally similar with those controls. So if what's going on and what this regression suggests is people are kind of paying attention to the 1 globe category, the 5 globe category, ignoring the middle, so we can dig more down into the data and see if the variation suggests that it's kind of similar things within each fund category and then moving over breakpoints differently, where funds that are pretty similar in terms of sustainability will just be in different categorized groups. So what we're going to do is we're just going to look at the average flows by each of the 100 percentile ranks underlying the globe variables. And so Morningstar confusingly decided low percentiles were good. So to the left are the high sustainability funds, and to the right are the low sustainability funds. And what you can see is, so the 5 globe funds are generally positive. So 9 of the 10 point estimates are positive. 5 out of 10 of the coefficients are significant at the 10% level. Kind of similar somewhat across category. If you look at the 2, 3, and 4, there's just not much action going on. There's some positive, there's some negative, there's a few significant, but not much driving it. And then if you look at the 1 globe funds, all 11 are negative. 5 out of 11 are kind of significant at the 10% level. Fairly similar. It looks like investors didn't like a bit more the ones that were really bad. So like the 99th percentile seems a bit more extreme. We run a formal RD test in the paper. It does look like there are significant breakpoints. If you look at the running variable of these ranks within each Morningstar category, which is, again, suggestive that what we're capturing is really something to do with these ratings. And then we just do a bunch more stuff that I'm not going to have time about. So back of the envelope, this seemed to have a significant impact. Again, like 15 billion, 20 billion in and out of these funds. We can do pre-period matching. We can look at funds that switch. We can look at web traffic. All the things suggest that investors really cared about sustainability. So now we want to get to the question of why. What seems to be going on? So again, the first part I think we can do super clean. This is going to be, making some progress, but definitely not getting definitive answers. So the first story is institutional. So, you're an endowment. You are being forced to do this because you're afraid students are going to occupy your office or something like that. And so if it's being driven by institutions, we can look at institutional share classes versus non-institutional share classes. We're going to interact the globe dummy variables and include the base rates. So the way to interpret these interactions is just how different were the institutional share classes from the non-institutional share classes. And basically, we're going to find they don't look that different. So this is consistent with the institutions kind of caring about this stuff, behaving like other investors. It's also consistent with maybe this isn't a good proxy of institutional investors. Maybe this is folks in their retirement accounts. But either way, it suggests it's not being driven solely by institutional constraints. Next thing is return. So if people had a rational expectation of higher returns, you might expect this flow pattern. I'd say there's various theories that are suggestive that you'd probably expect an inverse relation, if anything. There's some research out there that says maybe the market's mispricing this stuff. you'd expect positive returns. As more attention gets kind of focused on this stuff, you'd probably expect the lack of attention mispricing story to have less weight. But a big caveat here is we're looking at 11 months. Returns are really noisy. So I'm going to show you what we find, but you know, a year worth of returns only tells you so much. And so we're going to look at a bunch of different benchmarks. And the benchmarks are going to tell us similar stuff. So we're going to find estimates of between about 20 to 50 basis points underperformance of the high sustainability funds, very marginally significant. So p-values between about 0.06 to 0.2. You find similar things if you look equal weighted, if you do portfolio sorts. There's kind of, I'd say, suggestive evidence of underperformance, not any significant evidence of there being ex post higher returns to high sustainability, which is what you'd need under kind of a rational expectation of higher returns explanation. But again, it's 11 months of returns. So the last thing we wanted to explore is, okay, what about there were expectations of higher returns, but they didn't show up in the data? Or just kind of this charitable, type idea. These people are investing in this, they know there may be lower returns, and they're okay with that. So what we're going to do is run an experiment. And so what we did is we asked a bunch of Booth MBA students, a bunch of MTurk participants to rate hypothetical funds based on screenshots from Morningstar. So we took 3 somewhat similar funds that were all rated 5 stars. One was 1 globe, one was 3 globe, one was 5 globe. Then we randomized the globe ratings across all these funds. So we had these 3 funds, the 3 randomized globe ratings. And then we asked 3 questions. How do you think this fund will perform over the next year? How risky do you think this fund is? And if you had $1,000, how much would you allocate to the fund versus a savings account? So this is what they saw. It's basically the top of a Morningstar webpage. It's got price, a bit of information in the sustainability box. So this is what we found for the MBA students and the MTurk participants. Basically, both groups strongly thought higher sustainability funds would have higher performance over the next year. If you could say, well, maybe they thought they would also be riskier, and this is compensation for that risk, that we found the opposite pattern for risk. So both of these groups thought that the high sustainability funds would have higher performance and lower risk. Now, that doesn't mean that they couldn't also have non-pecuniary motives. And so what we're going to do is we're going to look at how much money they allocate to each of the funds after controlling for their expectations of risk and returns, and say if you allocate more to the 5 globe funds and less to the 1 globe funds, that's consistent with an altruistic motive. So the first order thing you see is that folks who thought a fund would have higher performance allocated more money. Folks who thought a fund was riskier allocated less money. So that's good. If you just put in dummy variables for globes, people allocated about $100 more to the high sustainability funds than the low sustainability funds. But that doesn't answer our question, which is column 3, which is after controlling for that performance and risk. You can see that some of what's going on, about half of that effect, can be explained by expectations of risk and performance, but about half of the effect is still there, which is consistent with there being a non-pecuniary motive. So after they filled out this survey, we said, what were you thinking about when you made these decisions? And we found about half of the MBAs said they weren't thinking about environmental or social issues at all, and the other half were. And so if this is about altruism, then it shouldn't be that the MBA students who weren't considering environmental factors exhibit any altruism. And so if we look at just the group who said they didn't consider the environmental and social factors, you'll see that they basically allocated the exact same amount of money versus those who considered ESG. That's the group who strongly allocated more money, consistent with these dummy variables capturing some non-pecuniary motives. And then our MTurk folks behaved broadly similarly. And so that's kind of the paper. Hopefully it convinced you that there's kind of this causal impact. And I think it leads to some really interesting questions about, how should such a system be constructed? What do investors actually want from the system? That kind of we don't really get at, but is kind of an interesting thing moving forward.
Thank you very much, Samuel.
Thank you for inviting me to this very interesting conference and to discuss this thought-provoking paper. Well, the summary is in 3 points. So there is no special difference before March 2016, before the rankings of these funds were published by Morningstar. But from in several subsequent months until January 17, there is a substantial flow into sustainable, the highest ranking funds, and substantial outflows from the non-sustainable, lowest ranking funds. And this is true controlling for a bunch of, like, for whatever controls you want to put in, prior returns, age, expense ratio, etc. And so the first conclusion is that ranks cause investor flows. The second conclusion is that flows reflect affection to sustainability. And my comments will mostly concern this part. Why is that? Because, well, it's not institutions that drive the effect, because the diamond variable for the institutional share class is not statistically different from 0. Moreover, the globe ranking do not help predict risk-adjusted future returns. And finally, if I run this lab experiment, people say that they expect the globe rankings to be associated with risk and return, but there is an additional effect that is linked to their altruistic ESG preferences. And here and there in the paper, there are also discussions of how some of the results would support behavioral theories. For instance, investors seem to focus on extreme rather than intermediate rankings, on discrete rather than continuous scores, and expect higher performance together with lower risk, okay? So, as I said, I will mostly talk about the first part, the flows reflect affection to sustainability, but I will also talk about a question that is not addressed in the paper and perhaps talks to the previous presentation. Do these rankings help sustainability? And so, what about the relevance? Obvious, it is a very irrelevant topic. Casual empiricism, like the rise of green parties in Germany like 30 years ago, the climate agreements, the consumers' boycotts, etc. Obviously, people care. But do they put their money where they care? And now there is, to this audience, maybe what is important to know is that in 2006, there was an initiative started, also supported by the United Nations, that is called PRI Initiative, that gathers a lot of institutions, 1,500 institutions, with an amazing amount of money and of asset under management, 62 trillion money. And they are very serious about PRI investing because they say, this is taken from their website, PRI reflect the view that ESG issues can affect the performance of portfolios. They therefore must be given appropriate consideration by investors if they are to fulfill their fiduciary duty. Now, why am I talking about this? Because there is a strange coincidence, which I will describe. In 2006, the PRI decided, the PRI initiative decided to strengthen their requirements to be considered like part of this network. And in particular, they ask members to have at least 50% of asset under management dedicated to ESG investments. And so, but why should we care about being PRI, being ESG? Well, also in 2016, there is some final regulation issued in the US that dedicates a lot of examples to the tax-exempt status of foundations. And it says, well, suppose you invest, and I'm thinking of not of well-known foundations with like clear ESG status, but I'm thinking of smaller foundations, maybe of small family business, and that maybe have some ESG goal, but maybe they have also like more private goals. So suppose they want to invest in corporations, but that is not an ESG investment. So they need a certification in order to gain or to keep their tax-exempt status. So my doubt is that maybe a tax-driven demand both for the certification by Morningstar and for the flows into funds. And by the way, Morningstar acquired in 2017 the company that provides the scores. Now, this is one point of my discussion. Now, forget about this. No. One more thing, two more things. So he says, okay, but we have the institutional shares dummy. And the paper is very honest. It says already maybe there is some heterogeneity because also some retail investors may invest in the institutional share class. And there are also other reasons why you wouldn't expect all institutions to have this demand for tax exemptions, because there are many institutions that do not care about tax exemptions, etc. So even though I'm good that there is that dummy variable, I would see some more discussion, some more evidence. And this could exploit cross-country variation in the publication of the scores or the ranks across countries, because foreigners need not have the similar demand for exemptions. And following on this idea of the tax exemption-led demand for ESG certification, I was also thinking maybe we can also understand why these institutions would buy the top ranking and sell the lowest ranking one rather than the intermediate ones. And the reason is that I want to minimize the need to reshuffle my portfolio. And since there is, this is the transition matrix from 1 globe ratings to 5 globe ratings and vice versa. Of course, if I sell this and I buy this, I minimize the probability of having to reshuffle my portfolio to stay in a highly ranking fund category. Now, so this is for the tax exemption story. I have another story, which is the risk story. Also, this is not really, it's surfacing, it's a bit Karsic River in the paper, the story of risk. But I think maybe we should want to think more about a possible risk motive. Why? Because the lab people tell us that the risk is one of the reasons why they want to invest in 5 globe rankings. And the second thing is that, yeah, it's true that globes do not predict the risk-adjusted return, but the risk adjustment is with Fama French factors. And why? Like, it's true that Fama French factors are associated with all sorts of risk, but do we think that they should be associated with regulatory, ESG regulatory risk? I doubt that. So maybe, and finally, it is known that expected returns can very hardly be predicted, whereas risk is more easily predicted. So what is my idea? My idea is that maybe the 5G, 1G portfolio, the 5G, 1G can predict differences in risk. And maybe this 1G minus 5G portfolio that has a positive return, although not a statistically significant one, is actually capturing regulatory risk associated with the ESG. And especially if it's going to persist, then I think that could be a very reasonable interpretation. And in this light, this Morningstar ranking complete the market because they make tradable a latent risk factor that was not tradable before. And one more word on the possible irrationality of the lab people who were saying, well, I like 5G funds because they have a higher performance and lower risk. And I think that this is perfectly rational. If higher performance means higher future cash flows because there is less downside risk, less regulatory risk, less risk of being caught non-compliant, then you would also expect lower expected returns. So it's the difference between cash flows versus returns that matters. Now, what's next? Okay, the big issue, but do these rankings have sustainability in the last place? And I think, yes, casual empiricism suggests that when Apple and Amazon were ranked low in 2012, they also did something to improve their rankings, and they did manage to increase their sustainability ranking. So they do something positively. But let me stress the negative aspect of rankings. And the negative aspect of ranking is related to the scores by Sustainalytics and other companies that do not currently account for taxes. Now, and of course, associated with taxes are public spending in social issues. And here I'm getting to Jeff Gordon's presentation. So suppose that company A is in Apple, A is in Amazon, avoids a 50 billion tax bill, and public social spending is 50% of tax receipts, then A's ESG investing should be reduced by 25 billions, and the fund that invests in a company A should also be downgraded, okay? Now, so this problem of ignoring taxation is, I think, something that should be addressed. And however, PRI, that initiative I was mentioning at the beginning, is actually promoting corporate tax transparency since this year. So yeah, they have just issued some new guidelines, and sorry for the bad picture, but investors should recognize that corporate taxes support society's tangible and intangible needs. So this will be taken care by the PRI new guidelines, but this is true only within country. It won't be true across countries. Why is that? Well, because there are differences not only in taxation, but also in public social spending, okay? So, and these big differences in public social spending, I didn't find a table public social spending as a share of GDP, as a share of taxation, but this is public social spending as a share of GDP. And for instance, France spends more than 32% on social spending, compared, let me get, for instance, Slovaks, Ireland, Slovakia, etc. So it means that a corporation that moves from France to Slovakia or from Germany to Slovakia is going to implicitly spend much less in social issues than it was before. And clearly there is also an indirect effect that distorts ESG scores, because a French company that stays in France pays a higher tax bills and contributes more to ESG, and yet it suffers from lower competitiveness, and so it will also reduce the ESG spending. So it will be damaged twice. So, last point, this is a point made by a recent paper by Manso. He is pointing out with reference to credit ratings, but the same applies to rankings, that there are feedback effects, that once investors act upon the rankings, then there can be a self-fulfilling aspect. So the French company that was ranked low by Sustainalytics and Morningstar will actually suffer from a higher cost of capital, and that will damage welfare ultimately if the initial scores, initial ranking was distorted. So I think that agencies should and probably will set scores that correct these cross-country distortions and modify scores even only if not every month, but only if they are really accurate because they have to take account the feedbacks. You have another point, but I think it's better to proceed to the discussion. So very nice, thought-provoking paper. Thank you.
Great. Thank you so much for the discussion. Lots of really interesting, cool things to think about. But since we're before lunch, how about I'll go for some questions, and if there's time at the end, I'll come back to it. Do you want me to do it, or?
Yeah.
Or sure.
So when I was seeing the outflows, I was thinking about information. So presumably lots of investors don't see these moves. So it seems that well. So in that sense, it's going to be an underestimate.
Yes.
And so my question is, did you think about, or would it be possible to have proxies for information acquisition? So for example, if it's more concentrated holdings, presumably they would have the incentive and the wherewithal to see these ratings. So just whether you could sort along that dimension.
So we could sort on, so we have Morningstar web traffic. So we could sort on funds that had higher traffic to their Morningstar web page. We could sort on we don't have it, but we could try to get I don't know, press information. So, but I don't think we've got because we need to know, so we don't have any holdings data. So this is, there's kind of those types of questions, unfortunately. We're talking and trying to get it from them, but we don't have it yet. But so we don't have a direct proxy for that, because you'd want someone who both had concentrated holdings, a bunch of their shareholders, and used Morningstar. So it would be, I don't think we have it, but it's a good question.
Yeah.
Whoever has a microphone.
So you were talking about the silent majority in the beginning, so I'm wondering to what extent your sample of investors is representative. And you didn't say much about, I think, the composition of the funds. So if I imagine, is an index fund a 3 automatically, or is there a special category for index funds? Because the background of the question is, last I checked, it was not a good idea to invest in actively managed mutual funds. So if people are switching between actively managed mutual funds, those are not people I would want to rely on for guidance. That's not who I am. I think most people nowadays more and more go to index funds. If MBA students are choosing these funds based on their past performance and their sustainability rating, I wonder what you're doing at Booth to train your MBA students.
So first, I think it is. I think it's not just Booth MBAs, but I think MBAs in general fall down on questions like thinking through the general equilibrium aspects of investor demand and stuff like that, and impact in prices. So in terms of markets, I would love to have the true universe of the financial markets. This is still, what was it? I had it up there, $20 trillion, or I think I said something like that, or 10 trillion, or I forget, it's multiple $1 trillion. So it's a big shock to a big market that there are lots of investors in. And so I agree, it absolutely isn't the universe. If you are a quant shop, you are not in my data most likely. That's not going to be a part of your strategies. And so, to the extent that you think the silent majority is, say, hedge funds and stuff like that, most, I'd say, folks in their retirement accounts are often in these products. This is a big chunk of investors, but absolutely only indicative of the folks in the US open-ended mutual fund industry.
If I may just clarify, I was not talking about hedge funds and other funds. It's clear, this is about mutual fund investors, private individuals, perhaps universities and so on. But there's segregation. Some people invest in index funds, presumably don't spend their time looking at Morningstar websites. Other people invest in actively managed mutual funds. Those are not the same populations. And so to the extent that this is about the treatment effect. It's a local treatment effect. It affects certain people. And if we're talking about the silent majority, maybe it's not a good measure for that silent majority. That's all I wanted to say.
Yeah, no, that's a fair point. If you, truthfully, yeah, so if you thought that the silent majority is kind of in this middle and that the shock has a big impact on the tails, then I think that's a totally fair point.
Yes, please, yeah.
All right, so I'm concerned with the word sustainability because in the sense that maybe when the investors are looking at the website, read the word sustainability, thinking about sustainability of returns as opposed to sustainability of the investment itself, right? Because if you're thinking about, oh, this is low volatility, and if the stock happens to be performing well, I'm sorry, the fund happens to be performing well, then presumably you're going to get a stronger reaction that way.
So I'd say two things to that. One is Morningstar really went out of their way to scream from the rooftops this was about values and making the world a better place. So to the extent you think that matters. Another thing we did that I didn't have a time to... No. Well, so it does. It says it's it's an ESG rating. There's descriptions. They made the thing a globe. So but what we did is we ran an MTurk thing where we said, what do you think when you hear a firm is sustainable? Basically, was kind of the question. And so the number one thing that we got out of, because we were just interested in, we're using the term sustainability because that's what Morningstar calls it. And so the number one thing when you get that question is it's something about the environment. Almost everybody thinks that the word sustainability has something to do with the environment. The folks who said it was about future performance was quite low. And then there was kind of a potpourri of other stuff that had various weights in there. So that's the extent we can get to direct evidence. But I guarantee you there's some investors who think that this is the new Morningstar rating of, something about returns, and they're in our data. But I think that there's probably a sizable chunk of folks who do think it's about sustainability because they tried to make it, I think, as obvious as they could.
It seems like you have a really nice shock to mutual fund outflows, so I'm wondering if you can bring in the holdings data as in the fire sale literature, right? So I imagine what you'll find is that the funds that have the inflows put out more buying pressure on stocks and reverse with the ones that have outflows. And then I'd be curious to see how those price trends reverse over time among the affected stocks in those portfolios, and then that might in turn explain some of your returns on those two sets of funds.
So I think it's a great idea. We're hoping to get the data, and it'll probably be another paper. So this paper we feel is kind of what did investors think about these ratings? There's a really interesting paper, I think, that hopefully we'll have the data to do, that's how did funds respond to the publication of these ratings? And that should tell us more about why we find the patterns that we do. Because if you have holdings, you can look at kind of what was held, what wasn't based on sustainability. You can say, was it the decision to drive it? Was it the underlying characteristic? Kind of what theory seems the most consistent with our results, which are currently, I'd say, broadly consistent with about 3 or 4 explanations. But so I think it's a great idea. Our data is anonymized, so we can't link it to holdings. We can't directly test for it yet, but hopefully we'll be able to. So we could go and try and scrape their historical website, which would be, I think, a fairly large task, or we can continue our slog with the data team and hope to get lucky there, which I think we will, and hopefully will be faster than doing it.
I'm curious to know what's your interpretation for the fact that there is no action in the middle. So is it that they are switching from the 1 to the 5 globe? Because I would expect still some even spillovers, even if you think that you only care about the super bad or the super good. I would expect at least some spillovers to be going on for the other ones.
Yeah, so I'd say I don't have a strong reason as to why it's more or less flat. I think the fact that it's much more extreme for the extremes is consistent with a lot of prior findings about how information is categorized and visualized, and that we focus on the extremes in settings like that. I think even things like the fund flow relations about returns, really convex in the tails. And similar things with Morningstar star ratings, though there is more action in the middle for the stars as opposed to the globes. So I think the extremes are really attention grabbing, really salient. If you're doing this for a moral reason, then maybe you're a bad person if you just buy above average versus high sustainability. But yeah.
If this suggests that people would really care or have very strong views about this, then why would you need the rating to show up, right? So you would be probably have the incentive to go after this information yourself, no?
Well, so I don't know if you would need so I think this is the type of thing that it shows up on the page, and now you need a strong enough view to be able to go, oh, I want to get this one, it's high sustainability. And so I don't know if the hurdle doesn't have to be super high. I think the cost is relatively low to switch it. So I don't think that means, if you go for high versus above average, I don't think that means that you'd be willing to go out and collect Morningstar holdings data and calculate it yourself, even though you could have. And so institutional investors, I think will have people, or historically had people do things like that for certification purposes, but that's kind of you need a consultancy to, I think, do that for a lot of these guys. So my guess is they just didn't do it.
I think a placebo test here may help you better distinguish whether it is the rating or it's the sustainability that is driving the flow. You have the MBA students, you can give them a bogus rating and put it on the website, make it very salient and see whether they react. You can give it a pretty name like smart rating or anything like that, just to see whether they adjust the flow based on that.
Yeah, so is it just a pure attention effect? Is definitely a concern. I'd say the evidence, and I'm more concerned with the experiment than the rating, but in the experiment, the fact that you get the kind of altruistic stuff for the folks who said they cared about the environment suggests that they kind of knew it had something to do with the environment. So something we did do placebo-wise is we made fake rankings in the pre-period, and so we redid the same thing, assuming it'd been March 2015, 14, 13, and you don't find any impact if you kind of form fake rankings before they were published. But yeah, we didn't do an experiment placebo like that.
I just had a couple of observations, and sort of the point that was made already on this side. I think the age of the lab people, as you call them, is material here because millennials have been proven time and again in a lot of studies to overweight the value of this phrase sustainability in their decision making. So I think you should run it again on the faculty. Another thought is on the performance things. I think you've already identified it, but you do really need to run it over a 5-year period in terms of the outcomes, simply because when investors look at the environmental and social factors that are material to a company's performance, the expectation is that shows through in performance over the long term, not quarter by quarter, not year by year. And you usually see it in significant events like Macondo or whatever, but on the margin it's over time, and it's looking at the quality of management. That's why we look at it. The other thing I think, it's less to do with your study, but it's a general awareness point. You asked, what do investors or what do the funds do with the rating? They pull it apart. Because we know more or less Morningstar's methodology and Sustainalytics methodology. MSCI has a similar methodology. A lot of us do our own methodologies on the raw data that we subscribe from one of these shops. And what we have found is the rating varies enormously based on the weighting you put on the different data.
Absolutely.
And so in our view, the most logical way to look at this is the binary, is this risk material to this company's business? Yes or no? And then there's a more moralistic judgment, probably based on other data. Is management dealing with this risk appropriately? And you get wildly different outcomes. And you used IRIS as part of your analysis. Yeah, you line them all up with their own little score. They're all over the shop for the same company in the same year.
Absolutely. Oh, yeah, yeah. So one of the things that I am not one of the things in this paper that I absolutely do not want to do is say whether this is a good or bad way to think about sustainability. I think actually in terms of identifying the effect, the fact that there are, I'd say, some clear shortcomings is really good for me empirically, because it sounds to me like what you're saying is, look, if you really cared about this stuff, you need to do a hell of a lot more work than just look at these categories. And I think that sounds very sensible, but what my results are kind of suggesting is that, well, at least in this market, folks aren't doing that. And that's where like that last question I kind of ended with is, so what do people actually think of these things? And based on those preferences, how would you actually go about constructing a reference to, or an index to like reflect that? I think is a really interesting question. And none of the things I've seen have convinced me that anyone's really nailed that, or that it's a particularly easy question to answer.
Maybe one more question. You also wanted to follow up on.
Oh, if we've got time, sure, but I don't want to hold people up for lunch. So. Yeah.
Okay, so I want to offer two ideas about thinking about how you might deal with some of the comments you got from your commentator. The one is about the 2016 potential confounding influences of the PRI statement for accountability and the 2016 tax. So the PRI statement of accountability, so a lot of large US institutions are now signatories to the PRI. They regard it as kind of like a good housekeeping seal of approval because clients want to see it. But it's kind of an eye roll acceptance of this for good housekeeping. So that's something that you can just kind of date because you've got a clean event date and kind of separate those out empirically. On the tax ruling, the IRS ruling, I think that I think legally it operated differently than was just suggested to you. I think legally what it said was that you could look to mission-related investing as a kind of substitute for distribution. And so if the investment was in your charitable purpose, then that would be like a distribution. So I don't know that would have as large an effect on flows, and you can also date. So theoretically, it shouldn't be as big, and then you can date that out. And then the last is just anecdotal with the millennials comment. So in the personal trust space, large institutions will tell you if you ask them that they are like Bessemer Trust, Northern, whatever. They're building out ESG capacities because it's the millennial generation that is now of age and starting to hassle about the investment function. And so it's a beneficiary demand response. So that's relevant for your experiment.
Yeah, no, so thank you very much. I have to admit that I don't know the tax law, so I'll talk to both of you and get the details. Should we call it there, or should I respond for a minute? Both. That is, okay, so I'll take that as like 30 seconds. So again, thank you for the really good discussion. My one thought with the tax, and I need to figure out what the regulation is that if you're sophisticated enough to be playing tax games, you're probably sophisticated enough to be in a low-fee share class. And so that means that, like, that's what those institutional dummies are. So my guess is that that's where you would find the tax action. And in terms of regulatory risk, I think it's a really interesting idea. The one thing there is you would expect that would already be reflected in the share price of the underlying holdings. So it'd be unclear why the fund should shift around kind of based on that one. But I thought they were great ideas. Thank you for the discussion, and let's do some lunch.